Hello everyone. The Monetary Policy Committee today decided unanimously for a status quo. Basically, it was 5:1, where one member voted in favor of a rate cut, whereas the other 5 members voted for a status quo. So basically, majority decision was to maintain rates at 6% on repo rate. Inflation guidance, however, was tweaked a little bit higher. The earlier guidance was 4.2 to 4.6, and the revised guidance now for March 2018 stands at 4.3 to 4.7. It's a small marginal tweak, so we don't assign too much of significance to that number. However, the policy decision was broadly in line with our expectations. This in a way signifies that RBI seems to be in a stance or a phase of a long pause with a neutral stance maintained. How did the bond markets react? So for the bond markets, it was like an oasis in the desert. And why do I say that is because the previous policy, which was announced in October, till date, the yields have almost risen by 25 to 35 basis points across the yield curve. And this was after a status quo and a neutral guidance given in the previous policy. So it was intuitive that quite a few negative news were getting built into the bond yields, and they continue to rise. Also, we saw consistently last couple of inflation data points, that is CPI, trending a little bit on the higher side. In that, the core CPI was also flattish or continuing to remain sticky. Interim, we also saw crude oil prices increase by about 15%. The good news or the silver lining amid all this chaos or clutter was that we had an upgrade for India Inc. by Moody's, which to some extent allowed for yields to find a stable position. That also seems to have given way. So therefore, it was very natural for the bond yields to take a breather after non-cessant rise in the past few weeks. The 10-year benchmark government security was trading at about 7.07, just ahead of the policy, and post-decision eased by about 3 to 4 basis points. The liquidity in the banking system, if not in surplus mode, is also not in the deficit mode. We believe that the liquidity in the banking system will continue to remain adequate, and RBI has also stated that open market operations, both a combination of OMO purchases and sales, would be adequately used as and when the need is warranted. At this juncture, the RBI has conducted approximately 90,000 crores worth of open market sales of government bonds. That has done enough to suck out the surplus liquidity. Going forward from now on till March end, at least we do not expect further OMO sales, which means that the liquidity condition, after deteriorating a little bit because of advanced tax outflows, should stabilize and marginally start improving post middle of December. What should be the outlook, or what is the outlook going forward? So clearly, as we mentioned, in the neutral mode, the RBI continues to be data dependent, and rightly so. We need to monitor cues from global markets, specifically from the US, as also data emanating from domestic markets, specifically the CPI. This, we believe, would set the pace for future monetary policy guidance. But for now, it's fair to say that the RBI seems to be going into an extended pause. How should bond market investors therefore behave? We believe that the carry on the yield curve at such elevated levels continue to provide decent investment avenues. Therefore, we believe focusing on the mid to short end of the yield curve into strategies such as ultra short and short funds would be the way going forward. This, we believe, could potentially offer a case for a stable bias on your fixed income portfolio and also allow you to earn the carry during your investment tenure. If yields were to rise non-cessantly, which is not a base case scenario that we assume, one could also look at dynamically managed funds in the long end space. But for now, I think the focus should be largely aligned towards the short and mid end of the yield curve. On a concluding note, bond market yields have been on an upward trend across the yield curve. These have been trying times. Key thing in this market is to remain patient, remain belted, and stay invested. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.